Good day, everyone. Welcome to our webinar for the 4th of September. Quite a bit has happened since last month, and I'd like to begin as usual in Wall Street, where things have been moving along. Donald Trump, of course, declared his trade war on the Chinese, and the Chinese have retaliated by allowing the yuan to weaken against the US dollar quite significantly by about 10%. Obviously, that is their weapon of choice in this war. When they allow the yuan to weaken, they make American exports to China more expensive in China, and they make Chinese imports into America cheaper in America. So it really does hammer the American trade balance. And of course, his trade war created this initial V-bottom, which we spoke about. And now that is devolved into what's called a flag formation here. You can see the flag formation. It's bounded on the top by resistance at 2938 and by support at the bottom at 2840. And it's oscillating between that. But what you should notice here is how big the candles are inside this flag. Some of them are huge. And that shows how volatile and uncertain the market is. Because on the one hand, you've got the growing American economy, which is driving the market upwards. And on the other hand, you've got this trade war with China, which keeps on rocking the boat. So the effect is this up-down movement with substantial daily ranges, but within this overall trading range. So now, of course, the flag will be broken on one side or the other. And we, as usual, believe that it will break to the upside, but it is possible that it could break to the downside. So if you see the S&P 500 go down through 2840, then you know that the correction that we've been involved in for the last month or two, is going to continue. But if you see it break to the upside above 2938, then you know this correction is nearly over, and we will almost certainly break the record high, which was at 3025 on the 26th of July this year. So that's basically what's happening on the stock market there. Of course, Donald Trump has caused international investors to move towards being risk off. In other words, whenever he jumps up and down about the trade war and slaps another 10% on the next 300 billion rands worth of Chinese imports, the international investment moves towards risk off. And when they do that, they take their money out of emerging markets and they put it into US T-bills, particularly the long T-bill, the 10-year US T-bill. And that causes the yield on the long T-bill to fall. And in fact, it reached a point now where the yield on the long T-bill, the 10-year T-bill, was lower than the yield on the short T-bill, the 2-year T-bill. And that's called a yield inversion, because normally people have to be paid a higher interest rate to tie up their money for 10 years than they do for 2 years. So when the yield on the 10-year bond goes below the yield on the 2-year bond, that is an unusual situation. It's called a yield inversion. And some economists in America believe that a yield inversion like that is something that is a harbinger of a future recession. In other words, it indicates that the economy is going to go into recession. We do not share that viewpoint. We believe that the economy is moving very well and will continue to move up very strongly in the future, and that is why we believe that the upside resistance here at 2938 will be broken rather than the downside support at 2840. Sorry, 2938, not 28. So in America, in July, the non-farm payrolls increased by 164,000. So they created 164,000 new jobs. That compares to June's 223,000 new jobs. The American economy requires about 100,000 new jobs every month just to keep up with the new people who are entering the job market. But anything above 100,000 obviously moves that economy closer towards full employment. Unemployment rate at the moment is about 3.7%, which is pretty much at a record low. So if you are in America and you don't have a job, it's probably because you don't want to have a job. Unemployment is very low there indeed. And obviously when you reach full employment, there are no more people to employ. Then what happens is that wages start going up, and that is inflationary. So the Federal Reserve Bank is watching that. They're also watching other things to see whether or not they need to put their foot on the brakes or on the accelerator. But as I said, in our view, this flag formation will be broken to the upside in due course. So now I'd like to just turn our attention to what's been going on here in South Africa, and particularly the attack on Cyril Ramaphosa. A fairly serious effort has been made to unseat him, and that of course has upset the markets a bit. I'm just going to go and take a look at the rand here. Right, here's the rand, and you can see the weakening trend that occurred before the election. Then Cyril Ramaphosa's State of the Nation speech. He won the election, then the post-election strengthening trend, and then the battle to unseat Ramaphosa, which has caused the rand to weaken substantially. At the same time, though, there was a significant international risk-off sentiment. In other words, the sentiment internationally switched from being risk-on to being risk-off. And as I said just now, that meant that international investors took their money out of emerging markets like South Africa and put it into US T-bills. And that obviously had an impact, a negative impact on the rand. Since then, however, things have stabilized at about 1550 was the highest level we reached against the US dollar. And since then, they've been trending stronger. So obviously, international investors are becoming more and more comfortable in the last week or so with what is going on in South Africa. They no longer believe that the attacks on Ramaphosa will be sufficient to unseat him. So they are buying back into our bonds. And that can be seen by the R186, which is our equivalent of the US 10-year Treasury bill. It's our long bond. And here you can see it on the screen. Just put a bit more data on. Maybe even 2 years, I think, 5 years. Okay, here, just wanted to point out to you that, for example, way back in December of 2015, when Zuma was still the president, there was a spike in the yield on the long bond up to 10.1%. More recently, in September last year, about a year ago, we had a spike up to 9.25%. So since then, the trend has been for the yield to get stronger. And that means that international investors are getting more and more comfortable with the political and economic risk in South Africa. They're bringing their money into this country, and that is bringing the yield on our long bond down. And you can see we had this attack on Ramaphosa. There it is in the yield, and it took us up to that trend line, and now the yield is backtracking, and we're down to about 8.14% on the R186 at the moment. So I would say that what we're looking at is a kind of darkest before dawn situation. And that is supported by what is happening in the economy. I'm sure you've heard the news that in the second quarter, GDP growth was 3.1% positive, which more or less compensates for the 3.2% decline in the first quarter. So now the remaining 2 quarters will determine what happens in the economy for the whole year. And I think that the Treasury's estimate and the Reserve Bank's estimate that we'll only have growth of about 0.5% is probably too conservative, given the growth in the second quarter. I think that we can look for growth closer to 1% than 0.5%, which is good news. I'm sure President Ramaphosa is very happy to see that. The other major factor, of course, is the consumer price index, the inflation rate in this country, which came down much more quickly than we expected, and it's now around 4%. As you know, the target range is between 3 and 6%, so 4% is below the halfway mark, and it opens the door for a potential rates decline or a reduction in interest rates by the Monetary Policy Committee, and they meet again between the 17th and the 19th of September, and I think we will get another 0.25% rate cut at that time. Of course, they will be influenced by how strong the rand is at that time, and also by the possible prospects of a downgrade from Moody's, which is the last rating agency to have South Africa on an investment grade. Those things will be factored into their decision. But on balance, I think that we can expect, especially now with the 3.1% growth in the second quarter, I think we can expect another rate cut of 0.25%. And then, of course, at the same time that that's been going on, Tito Mboweni, our finance minister, has said that, he's really getting stuck into reducing the size of the government debt. That seems to be his main target. Last month we spoke about his plan to cut 37 billion off the government wage bill over the next 3 years. And now, more recently, he said that he wants government departments to give him their budgets, but with the idea of cutting roughly 5% from government expenditure next year, and then 6% the year after and 7% the year after that. So that's very ambitious, and clearly he's getting stuck into this debt control thing. He also produced a plan which was based on 5 central ideas: modernizing networks, promoting agriculture, improving export competitiveness, removing barriers to new business, and also regional growth. These are all good ideas, but the only place where he touched on the union situation was where he looks to adjust the legislation so that small businesses and medium-sized enterprises are not bound by the agreements which are struck between large businesses and the unions. At the moment, if the large businesses and the unions come to a deal, then the small businesses simply have to apply that deal. They don't have any room to maneuver or negotiate. And that obviously is a constraining factor for small business in this country. So what Mboweni is trying to do is to free those small companies from having to pay the wages which have been agreed by the big businesses with the unions. But of course, the main problem in South Africa remains the power of the unions. And as Tito Mboweni tries to bring the size of the government wage bill down, he is inevitably going to go head-to-head with the unions at some point. All right, he also did something else which I think is interesting. He refused to grant SA Express their request for a 200 million rand government guarantee. What will happen there in due course, nobody really knows, but it shows that he is not just handing out cash to these state-owned enterprises just because they've got a problem. He wants them to solve their own problems. All right, let's turn our attention now to the commodities market. The gold price has been rising. We have talked about this previously. Just put the graph on the screen now. At the end of May, it was $1,280 an ounce. We put out an article on the 26th over here of June. I just got the arrow there. On the 26th of June, about the new bull trend in gold, which you can see has progressed quite a long way since we put that article out, and we're now talking about a gold price over $1,500 an ounce. It's gained about 15% in the last quarter. Obviously, the strike which took place at Sibanye meant that South Africa didn't really benefit yet from this rising gold price. In fact, gold production at Sibanye in the first quarter was down by 60%. But gold is at record highs, and it's at record highs in rands. So it's always important not just to look at the gold price in dollars, but also to look at the gold price. So there it is in dollars, and what we want is the rand price of gold. So here it comes. And what you'll see here is that the rand price of gold is actually at an all-time record high. If you own Krugerrands, you'll have noticed that the price has gone up quite sharply. Since we wrote that article, which is over here in June, the rand price of gold has made a new record high. And it's broken up out of a wedge formation. And it looks like we're going to see some quite strong upward moves in the gold price going forward. All right, and then a couple of general things that I wanted to just touch on before we get into talking about specific companies. The first one is, I don't know if you've been following the Bitcoin chart, but it's become quite interesting. Just put that on the screen for you. And I want to put 5 years, maybe that's too much. Let's go to 2 years. Okay, here we go. And you can see the initial meteoric rise in the Bitcoin price when it went up to these levels around $20,000 per Bitcoin. And that was followed by an inevitable correction. We did write an article over here when it was rising so quickly to tell everyone to get out of Bitcoin. There was a huge correction which has taken it down to these low levels here. Then we had an island formation and a clear upside breakout, and the commencement of a new upward trend. So it may be that Bitcoin is being seen by some investors as a safe haven, particularly against these trade wars which Donald Trump has got going with China. But you mustn't forget that Bitcoin has no fundamental value. It can only be analyzed technically because there are no fundamentals. It's not backed by gold or anything like that. And I think that you have to be a little careful in seeing Bitcoin as a hedge, a place to put your money during times of difficulty. I think gold remains the best place to have your money when you think the wheels are falling off. And then I'd like to just talk to you about a new technology which has come onto the market recently. It's called What 3 Words? What 3 Words? And it's a group of developers in the UK who've developed a system of precisely locating every single 3 meter by 3 meter square on the entire Earth's surface just using 3 words. So every 3 by 3 square will have a 3-word name, if you like. So your house where you live, your business, and obviously this is very useful because it's relatively easy to remember the 3 words and to communicate them. You don't have to send out latitudes and longitudes. You don't have to give physical addresses any longer. You just give the 3 words and everyone can locate you or what it is that you're talking about immediately from their cell phone. This is an incredible jump in technology, and we see this as becoming a world standard. In fact, What 3 Words has got the objective of making it the world standard for locations over the next 5 years. What 3 Words has also just done a deal with ER24, which is obviously the medical emergency company in South Africa. And the reason is that obviously it's easier for people to locate where they are in a time of emergency using this method. All right, let's turn our attention now to companies and listed shares. I'd like to talk about the banking sector to begin with. So I'm just going to put the banking index up here. Right, so this is the banking index. I want to put a little bit more information on the screen. And you can see what I've done here is I've got the banking index in the top half of the screen. And in the bottom half of the screen, I've got the dividend yield, the average dividend yield on that same index, on the banking index. And what you can see from this is that at the moment, the dividend yield on the banking sector is at a very high level. And that is unusual. And what it means is that the banking sector is relatively cheap in historical terms. In fact, it's the cheapest it's been for the last 10 years. If I put 10 years data on here, you'll see that roughly this is what I'm saying is correct. So, at the moment, the dividend yield on the banking for the whole banking sector is around just under 5%. But some banks, like ABSA, is trading on a dividend yield of 5.8%, and Nedbank is trading on a dividend yield of about 5.1%. That means that historically, these companies are cheap. And I mean, if you look at the Nedbank results for the 6 months to the 30th of June, they were regarded by the market as disappointing, which is one of the reasons the Nedbank share has fallen. But Nedbank still managed to make a headline profit in that period of almost 7 billion rand. So these are enormously profitable service companies, and they're trading on a very good dividend yield of around 5%. If you're a private investor, you could do worse than having some of these banks, these high-quality banks, in your portfolio and buying them on dividend yields of 5% or more. Because sooner or later, the big institutions will have money to put into those banks, and you'll see the dividend yields come down quite sharply as the share price goes up. Bank profits, remember, represent the overall economy, and the growth estimates for GDP have, as I mentioned before, changed now that GDP was 3.1% up in the second quarter. Okay, let's now talk about the NHI. This is in the healthcare industry. The healthcare industry has taken a hell of a pounding, and particularly when the NHI was proposed and accepted by Parliament, Discovery shares have fallen by 24%. So that's quite a substantial fall in a share which is generally reckoned to be a solid blue chip share. Now, our belief is that this NHI is quite a lot like the Land Reform Bill, in that we believe that it's not practical in South Africa, and that it will, it's really something which the ANC is throwing to the masses as a populist move, but they will not be able to afford to do it. This country cannot afford an NHI. We just don't have enough money to do that. So we believe that any money that is available should rather be put into making the existing medical system better, more effective, and that an NHI which promises free health care for everyone at the point of care is simply unaffordable and will not be implemented. It'll get tied up in the details, and we think the existing system will persist. So shares like Discovery, which have plummeted, as you can see on the screen here, 24%, at these lower levels, around 115 Rand, they look like very good value to us. We believe that Discovery is cheap at the moment, and if you want to buy some shares in this company, now is your time to probably do it. Okay, now let's look at Omnia. We did write an article about Omnia a little while back. You may recall that. Omnia is a diversified chemicals company. I'll just put a bit more data on the screen here. You can see that the share has been in a long-term downward trend. This company produces explosives, agricultural fertilizers, and chemicals for various industries. In the year to the 31st of March, their turnover was up by 7%, but they had an after-tax loss of 407 million. They've recently done 2 acquisitions, Umongo Petroleum and Oro Agri, and they've spent another 630 million upgrading one of their plants. That left them with a debt of 4.4 billion rand, and that in turn forced them to conduct a rights issue. Sorry, this is not very good. Let me go back to the 6-month chart. And we said at the time, we wrote an article about this, and we said that this share is a high quality share and it's very cheap at the moment. And our article was published on the 11th of July, which is over here on the chart. And we said that you should buy into the share when it broke above this trend line. The upside breakout occurred there, and in fact there actually. I think this trend line is slightly out. So it occurred at a price of 32.93, and the share price has since moved up to about 44 Rand, and that's a gain of about 30% in 3 weeks. So that's a pretty good move. Remember that the share still has a net asset value of 105 Rand. So even at these levels around 40 Rand, it looks cheap to us, and we believe that it will continue to move up. Okay, now I'd like to talk about Resilient, which is a real estate investment trust property company. It's linked to Lighthouse, which used to be called Green Bay, and also Nepi Rock Castle and Fortress. The share price, I'm just put a bit more data on the screen here. You can see the share price fell heavily after a report came out from 361 Asset Management, who said that the reason the price was so high was because there'd been these cross shareholdings between Resilient and Nepi and Fortress and what was then Green Bay, and that they were manipulating the price. Subsequently, there have been huge investigations into this matter. The share price fell very heavily down to this level and found resistance at about 66. And it's an interesting case of using that 65-day exponentially smooth moving average. You can see that your breakup came over here, and that basically that would have been quite a good place to get into the market at around 57 Rand on Resilient shares. We believe it's going to break above the 66 resistance fairly soon. We think it's looking at an upside breakout, so you may want to have a look at that. It's trading well below what it was just a year ago. All right, let's look at Sasol. We all know that Sasol has been through a very tough time. They're building this Louisiana chemical plant, which is called LCCP, in Louisiana, and there have been huge cost overruns and delays. It's now going to cost them nearly $13 billion to complete this, but they are nearly completed. They've nearly done it. And the share price of Sasol has come all the way down to these new low levels here, around 260 Rand. At this level, we see it as being pretty cheap. Obviously, there's risk involved here, but you're talking about buying into one of the biggest chemical companies in the world, in the fastest growing economy, the US economy. And we see this share as at or close to its bottom point. You may want to wait for it to break up through the trend line that I've drawn here, or if you're more conservative, you might want to wait for a break above the 65-day exponentially smooth moving average. But we think that there's value in Sasol at this level, despite all the difficulties that they've had and the setbacks. All right, I just want to mention Advotech, which produced results recently. The only thing I want to draw attention to on Advotech is that obviously we all know that this is an education company which competes with Stadio and competes with Curro. Stadio is in the secondary or tertiary education sector. Curro is on the early education up to matric. But Advotech does both, so it competes with those two companies. What's interesting is that Advotech at the moment is sitting on a price-earnings ratio of 13, actually about 14 now. And that compares with Curro, which is on a PE of 25, and Stadio, which is on a PE of 27. So we think Advotech represents value at this level. It has more or less the same upside potential, the same blue sky as Curro and Stadio, but it's just much cheaper. All right, and then Murray & Roberts, this is the last share that I want to look at. Murray & Roberts has been through a very tough time over the last few years. They have been under pressure together with the rest of the construction industry. They've been hammered down, but they now seem to be turning the corner. They've got a very strong order book with 46.8 billion in orders, and they've managed to reduce their debt to 1.8 billion rand. Their earnings for the year to the 30th of June were up 26% at 337 million. Their US subsidiary, which is a company called Clough, C-L-O-U-G-H, has just won a massive deal there for $620 million. The Aton takeover bid is pretty much off the table at the moment because it was opposed by the Competition Tribunal. But as you can see, technically, the share is formed in Ireland, and what we've got here is an upside break. So we think that this share may be in a recovery phase. Folks, that's about all I've got for you today. I hope you enjoyed it and you learned something from it. And I wish you good investing over the next month. Otherwise, I'll see you at the beginning of October, first Wednesday of October. Thank you for listening to me.